$10,000 per month is my end number, but I'm here with, $30,000 in savings, and I've got to get up to millions of dollars to generate all that income. How do I put all that together to get to a point, maybe 10 years from now, where I can have that $10,000 per month? Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach Carson, and this is a show to help you get out of the financial grind so you can do more of what matters. As you could probably tell from my voice, I'm fighting a little bit of a cold, but the show must go on, so please bear with me. A little funny story about me getting sick. As you might know, we transitioned back from Spain about a month ago as I'm recording this. We moved back to the United States, and one of the things I personally have a hard time with is the change in schedule. I'm not an early morning person, believe it or not. A lot of entrepreneurs and people get up early. 7 o'clock is kind of my time, maybe 6:45. And in Spain, that worked perfectly because school started at 9 for my kids. We had an hour or two I could even write my book a little bit in the morning and then take them to school and have breakfast. Everything's a little earlier in the United States. So we're taking our kids to school a lot earlier. I'm getting up at like 6:30, and that's just not working for me. So I'm still transitioning, but enough about me. Today's episode is a topic that I did write about in the book. And one of the things I try to emphasize is that most of us have a specific financial independence number. For example, maybe $10,000 per month is the number we need to replace our job income or to cover our basic expenses plus some nice luxuries. I call that your financial independence number, and you can break that down into your lean financial independence, regular financial independence number, which is like kind of your normal expenses. And then a fat financial independence might be your normal expenses plus some luxuries, plus some cushion in case things get out of hand with inflation. And so it's a more comfortable financial independence. And whatever level works for you is fine. And getting to that lean financial independence is a great spot. The point is, though, there is a specific number that I recommend you shoot for. You don't have to take a lot of time to determine that. Just have a goal, have a number. But something I want to do today in the episode is give you some case studies. One of the things I try to do in the book is to make this real by sharing stories, a lot of stories of real people, but also you might be wondering, all right, $10,000 per month is my end number, but I'm here with, $30,000 in savings, and I've got to get up to millions of dollars to generate all that income. It might be difficult to think about what does the path look like? How do I go from buying that first deal? Maybe you're going to do a house hack or something else. How do I put all that together to get to a point, maybe 10 years from now, maybe 15 years from now, where I can actually achieve my goals, where I can have that $10,000 per month? Well, that's what I'm going to go over in the episode today. I'm going to go through a presentation I've been making actually when I speak in person, where I share two different stories, two different paths to get to that $10,000 per month number. Now, I want to emphasize up front, there are dozens and dozens or maybe hundreds of different paths to get to financial independence. There's not one best path. So as you listen to this and the specifics, I hope the specifics are helpful. I hope you hear like, oh yeah, that's a technique that I could use, the burst strategy or the house hacking or paying off debt at this point. That doesn't mean that specific tool and that specific way is the only way to do it. So if your path looks a little different than this, great. No problem there. I love helping people customize their own financial independence path. So I just want to give you examples here to make it real, to give you some stories, to give you some numbers, and I hope you find that helpful, and let's get started. So I'm going to start by telling you a story, a case study of a couple who live in St. Louis, Missouri. Let's call them Liz and Tom. That's what I called them in the book when I told a similar story in The Small and Mighty Real Estate Investor. And just as an aside, if you're listening to this podcast on audio only, that's great. Thank you for listening. But you might want to make a note to go back and watch this episode on YouTube. All of my episodes are on YouTube, so you can watch the video as well. This one in particular, though, I'm going to have some charts and some numbers and some details and kind of a timeline that might just be easier if you can see it as well. But let me give you some details on the background of Liz and Tom. First and foremost, they both work at W-2 jobs, meaning they have regular jobs, 9 to 5, that they make income at, and together they make about $90,000 per year. They've also worked hard over the last few years to save up money, and so they've paid off some personal debt. They have got an emergency fund, but in addition to that, they've saved up $35,000. So they're not brand new beginners financially. Some of you might be listening to this and you're still in a lot of debt. I mean, you have credit cards to pay off and personal loans to pay off, or maybe you're just trying to get your job going. I emphasize that because your real estate journey often sits on top of a solid foundation of your financial journey. So it could take years sometimes to get to a place where you're ready to invest in rental properties. And that's okay. You could be learning, if you're listening to this, just learn and understand the tools of real estate investing. Maybe you do buy a principal residence. That's often the good way to get started, which I'm going to share in a second. But the point is, Liz and Tom have gotten to a place that they didn't just start yesterday. They've had to take some time to save up this $35,000. So now that you know how Liz and Tom started, I want to take you through their real estate journey from beginning to end. So at the beginning of Liz and Tom's story, they owned a house. They live in their residence. That's the one property they own. And so the way they started their journey is just renting out their current house and then buying another house to move into. Now, this is such a simple strategy. I call this your live in and then rent. And it's often so simple that it's overlooked, but if you just did this in the beginning, this is a fantastic way to get started. Now, why is that? Is that you already own this property that already has a mortgage. You already had to put a down payment on it. And I'm imagining, because it's an owner-occupant loan, it might be the best interest rate possible with the longest terms possible. And perhaps you got in with a lower down payment. So the financing itself is a great way to get in, because when you live in a property, there's just better financing for getting started. The other benefit is that you know the property. Now, not all houses are going to be great rentals. So if you own a 3,500 square foot property with multiple heating and air units, there's a lot of things to break, and that's a lot to have to repair every time you move out of a rental. So the typical or the best rental might be a house that is 1,500 square foot to 2,000 square feet. At least that's my ideal. But the smaller, the better. The simpler, the better. It doesn't have to be a tiny house, but if it's simpler, it's going to be better to be a low maintenance property. And the better your materials are, so that you don't have to replace them all the time. For example, if you have floors that are hardwood floors or tile, a luxury vinyl plank, or if you have exterior siding, I love brick or something that's kind of low maintenance. But the point is, you're not ever going to have a perfect property, but often when you move into the house, you can decide, okay, this is a good rental property that's going to be a good rental long-term, or no, this is not such a good rental, maybe I should sell this one. But in this case, Liz and Tom had that situation. They kept their property and they just bought another residence. And so at the end of this beginning period, when they just started, they have a residence, they have a rental property. Now, fast forward about a year, they're studying, they're listening to podcasts, they're reading books, they're networking with people, and they learned enough to buy their third property. And this time they just bought a pure rental. So remember, they had $35,000 saved up, which they probably used a good bit of that to buy their residence when they moved into that. But they were able to save up money and work really hard and not, sacrifice a little bit. Maybe they didn't go on a vacation this year, but this is early in their journey and every single dollar counts. So they're able to save up enough money to buy their second rental. And it was nothing fancy. They didn't do any fancy burst strategies or seller financing or creative stuff, which I'll talk about here in a little bit. They just bought a typical single family house, put 20% down, and that's it. But now they have two rental properties, their former residence and this new rental, and they have their residence they live in, and they keep moving forward. So by the time they get to the end of year two, both their money, their wealth, but also their knowledge has really compounded. And this is something you don't maybe think about when you're in the journey, but your knowledge is the most important factor to how well you grow, in addition to having the money. But what you find is that the more you know, the more you learn. If you can learn techniques, if you can copy other people and how they've done it, you can then figure out ways to be creative with the money. And so in this case, at the end of year two, they decided to ramp things up a little bit, and they learned a strategy called the BRRRR strategy, which you might have heard of before. Buy a property, renovate it, and then get it rented out. So you buy a fixer-upper property. And typically the best part about a BRRRR strategy is buying it below value. So they were out, generating leads, they're marketing, they're doing driving for dollars, they're sending direct mail. I talk a lot about that. And that's one of the most important skill sets you can have, is finding good deals. And when you're in this acquisition, this load up phase like they're in right now, their main focus is, let's buy properties. You have to do a lot of inertia, a lot of work to ramp that up to where you can buy properties. But they'd used up all their money on their prior rental. So people run out of money. That's what happens. It happened to me. It might have happened to you, some of you listening. So they had to think outside the box. And they were able this year, the end of year two, to buy two properties instead of the one they bought the prior year. And they were able to do that with the BRRRR strategy because it's a way to recycle your money. They found good deals. They used private money or maybe hard money or maybe a commercial loan from a local bank. So they used some kind of short-term debt to cover all of their costs. Maybe they had to use a little bit of their own money, maybe a line of credit. You got to get really creative and scrappy early on just to put together all the money. But the point is, because they found good deals below the full value, 80%, maybe 70% of the full value, they're able to refinance the property, pull out or pay off all of the cash or the debt they had used to buy the property, and then they can do it again. So if you look at the scorecard at the end of year 2, they've bought 5 properties now, their residents plus 4 rental properties, and they're picking up the pace. And I want to kind of accelerate how I'm explaining this a little bit as well. Each year, they go on a pattern of buying 2 properties per year. And they also continue the pattern of expanding their financing toolbox. That's one of the patterns, one of the themes I hope that you pick up on here is that first you walk before you run. It's okay to use the live in then rent or the house hacking, some kind of strategy and buy a property per year or go nice and slow when you first start. But eventually, as that knowledge compounds, as your money compounds, you then can pick up the pace. And they're not going at a crazy pace here, but just 2 properties per year. And they start using different types of strategies to get the financing. So the next time they buy properties 6 and 7, maybe they use the BRRRR method for one, maybe they use seller financing for another. Seller financing is a great tool. There's a lot of different variations of that to get in with a smaller down payment. And in a year where interest rates are getting really higher, and that might stay for a while, getting seller financing can also allow you to buy a property with an interest rate below the market value. So instead of paying 8%, maybe you can get 6%, even 5 or 4%. It's very possible. I've done it before. Lots of people have done this. It's something you want to learn. And if you want to go deeper on how do you negotiate seller financing, I'm going to have a link in the show notes in the YouTube description to a podcast and video I did earlier that kind of goes through all the negotiation strategies and why that's different than a typical property you're buying. But this couple, they learned how to do it. They bought some properties. So let's just kind of accelerate here. End of year 3, they bought properties 6 and 7. These are more single family houses. Year 4, they bought property 8 and 9. Year 5, they bought property 10 and 11. And they're rolling, they're just consistent at this point. Year 6, they bought property 12 and 13. And then year 7, they bought property 14 and 15. And the details of those, we could go into details, but the main point is they use a variety of financing tools. Sometimes they use their own cash as they're able to save up money, but many times they ran out of their cash and they had to get creative by using other alternative financing sources. But the point here, and let's pause, they made it through 7 years. And whether it's 5 years or 7 years, that's a pretty typical time period from someone who starts to someone who kind of gets to the point where they've finished the load up phase or the acquisitions phase of their rental property journey. Now, I like going in 5-year increments, sometimes 3, sometimes 7, just in life in general. These are often where I take mini retirements or take a break, or maybe you take your foot off the pedal on how much work and time you're putting into real estate investing. That's kind of a natural thing, like our lives go in patterns and ups and downs. To think that you can go 10, 15, 20 years at the exact same pace, really, type A, going, is really difficult. That can burn out your health. It can burn out your mental capacity. It can burn out your relationships. And so I just like to emphasize that whether it's 7 years or 3 years or whatever, it's nice to have kind of some cycles there of patterns of on and off. And that's okay. If you take a break for a year or 2 and then get back into the rental property business, that's perfectly normal. In fact, you might be better in the long run taking those little breaks. But Liz and Tom, just to kind of summarize their story, we get to the end of year 7. They've got their 15 properties. They're managing those properties, self-managing them. They're doing some work on the side. They're still working their full-time job. So they're busy. This is a busy time of their life. But they've decided that they've hit this point that is enough. And this is one of the key components that I talk about in the Small and Mighty Real Estate Investor is understanding the numbers you're trying to get to. And that you don't have to have 100 properties or even 50 properties. In this case, they don't even need 15 or 20 properties. Once they reach these 15 properties, they say, you know what, if we paid off a good chunk of these properties, maybe some of them, maybe all of them, we would have enough money. We could have $10,000 per month coming in for the rest of our life with low risk. And we can start taking more breaks. We can start having that 2-hour real estate work week that Chad talks about. Let's see if we can figure out a way to change our pace, to change the game we're playing here and kind of pivot our strategy. And that's the key here. This is another theme that a lot of people, they learn how to grow. They learn how to start and how to grow, the starter phase, the builder phase, but they kind of miss the off-ramp for taking this different route of turning from a builder to an ender. And so Liz and Tom, they took the off-ramp here and they said, you know what? We're going to start using all our extra cash flow from our rental properties. We're not going to touch any of the cash flow in our rental business. And any money we make in our W-2 jobs, we're going to put 100% of that, not on new properties anymore. We've got 15 and we're happy with that. We're going to start paying off the debt using a rental debt snowball. I've done another video, which I'll put a link to, on how the rental debt snowball works. It's a lot like the personal finance debt snowball, where instead of paying off a bunch of properties over 15 years with 15-year loans, take 100% of your cash flow, pay the minimum amount on all the properties except for one, and take all of the extra cash flow and pay off one property at a time. And so you're basically taking a big snowball of cash and paying that property off very quickly. Instead of a 30-year mortgage, you could pay it off in 2 or 3 years. And so that's what Liz and Tom start doing. They start applying extra cash flow towards one property that gets paid off. Now they free up some extra cash flow there. Then they go to the second one, which happens a little bit faster, and then the third. Notice though, this is kind of a slow grind, and you get impatient. And this is kind of the difficult part of building wealth, where you can get bored, you can get impatient, you can get frustrated. And so it takes a lot of self-discipline to get through this stage and to stick to your plan. And when they even get into that plan, they're like, we are a little impatient. And so they pull another tool out of their wealth building, their small and mighty real estate investor toolbox, which is to add to the debt snowball, selling off some of their excess properties in order to end up with a smaller number of properties. So remember, they have 15 properties. And so the end of year 15, and this could have been at year 12, could have been at year 8. I'm just kind of picking a number, but 15 is a nice and round number to think about. I could actually finish my journey from start to finish in 15 years. Most people work their entire lives and never get to this point. But at year 15, they decided to sell 5 properties. And something I talk about in the book is pruning your properties, like pruning off the properties that are not your ideal rentals. And so Liz and Tom have made a list of all their rentals, which ones are their favorites, which ones are the best locations, which ones are the best properties in terms of low maintenance, which ones keep their tenants the longest. And on the other end of the list, which ones are their worst locations, the worst properties in terms of maintenance, the ones that don't attract the best tenants who stay for a long time. And so the ones at the bottom of the list are ones they prune, almost like you're pruning an apple tree. You're going to cut off the branches of the tree and get rid of those branches by selling the properties in order to make the whole tree healthier, in this case, your whole portfolio. And so they decided to sell 5 properties. And the benefit of that, they could go take these properties, sell them, and buy more properties with them. That'd be the efficient growth strategy. But instead, they choose to sell the properties, pay their realtor commission, the closing costs, whatever they have to pay mortgage, pay off the debt on those properties. So I gave you some numbers here if you're watching on the screen. Let's say they sell all 5 properties for $1.25 million. They have sales costs of $62,500. They have their mortgages about $518,000, and they also have to pay income tax. And I have a video on income taxes if you want to see how much tax you pay on a rental property. I'll put a link to that as well. But I'm just going to summarize for you here. Maybe it was about $150,000 in income taxes. Now that hurts to pay that income tax if you're trying to maximize your growth. But in this case, what they're trying to get to is a simpler portfolio. And they're trying to get to that cash flow, that $520,000 or so that's left over that they can then use to apply to the rest of the debt on the properties they're keeping. So let me pause there because I've been through a lot of details here to understand what we've done here. 15 years later, they now own 10 rental properties. They own their best 10 rental properties. They picked the ones that are the best ones to keep. They've been doing a debt snowball for a while to pay those debts down, but they weren't all the way there. They needed a little bit longer. So they finished the deal by selling 5 properties, using the $519,000 to pay the rest of them off. They now are in a spot where they own those 10 properties free and clear with no debt. And let's take a look at what those numbers would be for Liz and Tom after this all said and done. Now, if you're watching on this YouTube, you can see the chart of all of these properties, but I'll summarize for those of you who are listening. Again, they own 10 properties, and each property they own, we're just going to make it pretty simple. They all have about the same rent. They're the same type of properties, that each property rents for $1,800 per month. So 10 properties times 1,800 equals $18,000 per month in the rent that they collect. But of course, they don't get to keep all that rent. They have operating expenses like taxes, insurance, maintenance. They got to save money for capital expenses like replacing the roof. They might have to pay a management fee. In this case, they're probably going to self-manage. But in any case, they have other expenses. And I'm going to say, just estimate it's about 40% of the rent they collect. So 40% of the rent they collect goes away to those operating expenses. So they have 60% left over. In this case, that's $1,080 per month per property. Or on the 10 properties, if you total all that up, that's $10,800 per month in cash flow that goes into their bank account. Now, remember, the promise of this whole episode was, how can you get from zero, from scratch, to having $10,000 per month? Well, we've accomplished that. It hasn't been easy. It hasn't been a short journey, but there are a lot of details along the way. But this is a pattern that Liz and Tom were able to get to have 10 free and clear properties. That is a super simple portfolio to manage. They can definitely do this with less than 2 hours per week. They can be very flexible. Yes, it's still a little part-time job, but it's passive enough. You can do a lot of things you want to do, and they're making $10,000 per month or $129,000, almost $130,000 in income per year. For many people, that is going to be plenty of money to do whatever they need to do. And Liz and Tom have probably also set aside some money in some kind of 401k. And so a very typical pattern, this has been my pattern as well. Real estate is like my first foundational piece of my retirement plan or my income plan. So this is like an income floor that I have with these rental properties. And then you also have other investments. So you have your 401k, hopefully, and maybe that has an index funds or stocks or something kind of diversified away from real estate. Whatever it is, Liz and Tom kind of had two, kind of a plan A and a plan B, and they don't have to touch their retirement account though yet. So if they started when they were 35 and now they're 50 years old, they can start using the rental income to leave their jobs. They can take trips. They can do the things they wanted to do, and they don't have to draw out of their retirement account yet. They can have the real estate plan and then the other plan. So that's the summary of it. I want to show you one more thing, though, about what their wealth looks like at this point. So some of you spreadsheet nerds like me out there might be saying, well, what is the value of the properties? What is their net worth? And I'm just going to summarize this again. If you're watching, you can kind of look at all the details. But each house in the end is worth about $250,000. I know if you're in big, most expensive states out there, you're going to say there's no properties that are worth $250,000. They're in St. Louis, Missouri. There are properties today worth $250,000. And if it's 15 years from now, of course, those will be different numbers. So I've had to use numbers that we understand today, assuming they started 15 years ago. But they're all worth about $250,000. Remember, there's no debt on any of these properties. So they have 10 properties times $250,000 is a $2.5 million equity position today in the end after paying their properties off. When they first started, remember, they had like $35,000 to start. So they had to skimp. They had to put, a few $1,000s down on their first property and then maybe a little bit more on the second property. So you can see in the spreadsheet how they started off with less money down. Over time, they were able to use burst strategy, maybe save up some more cash to put more money down. And eventually they started using the debt snowball to pay off their properties altogether. So it's really good to see these balance sheets like this, these spreadsheets, to see the evolution over time of how you can start with a small amount of money, end up with a large amount of money, and you're attacking it from multiple directions. You're saving money, you're saving your rental income, you're growing your wealth by buying properties below their value. The properties are going up in value. So this is the essence of building wealth with real estate in one spreadsheet. You can see how you can start with $35,000 and end up 15 years later with $2.5 million. It's a big number, but very realistic, something you can do using a very deliberate strategy like this. Now, as exciting as the end of that story is, and $10,000 per month is a nice place to be, and I hope some of you resonated with Liz and Tom's journey. I know others of you are saying, that's not my journey. I live in a high cost of living area. I'm not going to be going that exact same route. So I want to give you one more example that shows you a little bit different path to end up getting to the same place with the same amount of monthly income. Now this couple, let's call them Tiffany and Darius. That's the same names I used in a very similar example in the book, The Small and Mighty Real Estate Investor. They live in Oakland, California, so in Bay Area, high cost of living area, and together they make about $300,000 per year, but this hasn't been an overnight journey for them either to get to this point where they're ready to invest. They've had to get different jobs, they've had to move up in the job world, they've had to pay off personal debt, they've had setbacks here and there, so they've gotten to the point where they feel comfortable financially, their personal financial foundation is good, and they have about $100,000 saved up in a savings account to use on real estate. Now in the Bay Area, even though $100,000 seems like a lot, it doesn't go a long way. So let's talk about how they got started on this journey. And the way they did it is one of my tried and true favorites, especially if I'm in a high cost of living area, is doing something called a house hack. So they find a multi-unit property, either a pure multi-unit rental like a duplex with 2 apartment units, or they convert a single family house into more of a kind of quasi-duplex by putting an ADU, an accessory dwelling unit, in the backyard. And California is a great place to do this. There's a lot of local laws that have changed over the last few years that allow you by right to put ADU units, which you can rent out, or you could even go really aggressive, live in the ADU and rent out your house. But the point is, they were able to find a property with an owner-occupant loan, which allowed them to get in with lower money down. They had to search, but they got their journey started by buying this property, using their down payment, and moving into the property. That's a house hack. So house hack has a lot of benefits, but one of the benefits, as I said, they can get in with a smaller down payment. You can use owner-occupant loan. And you kind of learn the rental business as you go. Now that you've got your foot in the door, you can learn to be a landlord a little bit. Just with one property, it's next door, you can pay attention to things. And they do that for the next 2 years. So they're not like coming out of the gate sprinting and buying a lot of properties. This can be one of the difficult things when you're listening to podcasts and hearing how people are buying dozens of properties at 22 years old in their first year in real estate. And here you are buying one duplex and you're just sitting on it for the next 2 years. But you're not sitting doing nothing. You're paying your loan down. You're learning how to manage a rental property. You're saving up some more cash from your job. Remember how Liz and Tom, those first few years, every dollar counts. So Tiffany and Darius are saving up money. Maybe they're not taking that big, huge vacation that they normally would because they want to invest in real estate. And they're taking their $300,000 earnings, which is their engine for their investing, and they're saving as much of that as they can so that 2 years later, they can do the same thing again. They can keep their existing duplex that they had or the house with the 80 unit. They keep that as a rental, and then they buy another property and move into that property. So they now have the old duplex that they lived in. They had this new house hack that they're living in, and they live in that for another year. So that's 3 years that they have those two properties. And again, the psychology of that is probably the hardest obstacle to overcome. Not comparing yourself to others, seeing everybody on Instagram posting how many properties they're buying, but this is progress. This is the early days are not going to feel as fast as you want. But by year 3, their knowledge is compounded. They've been networking with people. They've been reading books. They've been learning and observing how other people are doing it. And they figure out how to use a strategy that we talked about with Liz and Tom called the BRRRR strategy. And they found some properties in a little outlying suburb. I like to call these satellite cities. So you start with like the sun of the solar system is the big economic center, maybe San Francisco in this case, Oakland, but then going out 30, 45 minutes to some of the suburbs where the regular people live, where people, even though it's super expensive, even in the suburbs, this is where your people who are your policemen and your firefighters and your technicians who work for utility companies and your nurses and your teachers, the regular blue collar workers live, and you find properties that are more affordable than they would be in the city centers. But the cool thing about these satellite cities, the outside of the main ones, that they're kind of orbiting the big economic center, is the prices are typically a little bit lower, but they also have their own city center of gravity. Like I love finding towns. I grew up in Newnan, Georgia. Newnan has its own little downtown. It's an interesting place to live. It's walkable. Walkability is really important to me. And so you can find these little suburban towns that have their own character, have their own town center. And that's what Tiffany and Darius did. They still had to spend a lot of money. These weren't like the best cash flow deals ever, but they were able to find deals below their full value. They were fixer-uppers. Maybe they found a pre-foreclosure. They used their skills to drive for dollars, find deals, network, and they bought 2 rental properties in that 3rd year, and they used the BRRRR strategy to use private money or a line of credit or some other way to get the cash up front, and they refinanced it with a long-term loan, which leverages their jobs and their income and their credit that they have. They were able to get long-term loans on these 2 rental houses in the kind of outskirts of the Bay Area. So at the end of year 3, they own 2 rental houses, they own the house hack that they still live in, and then they own the original house hack. So they have a total of 6 units. Now let's fast forward another 2 years. They're still going at a very deliberate pace. They're not buying any more properties until year 5. They're kind of at the end of their load up phase when they decide they're going to actually just buy their principal residence. They found a great home with a view that they love. And they just decided, this is our home. This isn't a rental property. We're never going to move out of this house. At least we don't plan to. And so they just move into the residence. And so that's at the end of year 5. All right, so this is another fork in the road, kind of like with Liz and Tom, where they go transition from a point where they started, and then they were in the wealth builder phase, taking the small amount of money they had and turning into a lot more. And now it's just patience, sitting for another 5 years of just managing their rental properties, living in their home, working their jobs. This can be a psychologically tough time. You've got to network with other people. You've got to talk to other investors. They're just kind of sitting on their hands, not doing a whole lot. But in this case, they're getting ready for something that when the time is right, they're actually going to sell their properties. Now, maybe they didn't think about this originally, but they get to the end of 10 years after they bought their first property. Their properties have paid down in value. They've paid the loans down, but this also given them enough time to go through some economic cycles. And in a lot of the high cost of living areas, you will see it's kind of like a roller coaster. You'll go way up and then way down. You've got to be willing and able to hold through those cycles. But if you do, one of my mentors, John Schaub, said the wealthiest students he's had over the last 5 decades were people who bought in the high cost of living areas, like in California, Southern California, Bay Area. Their properties have gone up enormously in value compared to maybe somebody like me who buys in a steadier, cash flow centric place, which has its advantages too, but I didn't build as much equity, as much wealth as they did. And in this case, Tiffany and Darius, that was their strategy from the beginning. It wasn't to make a ton of cash flow in the first 5 to 10 years. It was to make enough cash flow to pay the bills and then let these things grow over time, because they believed and they studied the city. They believed that it would go up in value over time. They didn't know exactly when it was, but they waited until the right time. At the end of 10 years, their plan is to sell all of their Oakland rentals. So remember, they have 5 properties total. They have the house they live in and then 4 rental properties, and 2 of those are duplexes. So they have 6 rental units, but they're 4 properties. They decide to sell all 4 of those that have gone up in value, and they're going to do a 1031 tax-free exchange. So this is a way of taking the equity they have in one market and then selling it and moving it to a different market. Now, I'm simplifying this example, saying they do it all at once. Maybe they do this in pieces. That'd probably be a better strategy unless they found all the deals at one time. Maybe they sell one of them and then another and then another. But the point is, to summarize this story, they sold all 4 properties, made about $2.6 million in kind of gross sales. They had sales costs, paying real estate commissions, things like that. They had mortgages they had to pay off. Let's just say it was about $1 million. And when it's all said and done, they had just under $1.4 million of equity left over that they could use to reinvest in something else. And their strategy was to go back to a market that they knew pretty well in Greensboro, North Carolina. They happened to know there were some multi-units there. They had some relationships they built on Bigger Pockets or somewhere else. And they found some properties that altogether were about 50 units. So multiple small multifamily properties. And their strategy was to use the equity in these California properties as 30% down payments on these multifamily properties in North Carolina. So when the dust settles, let's take a look at what their cash flow looks like in North Carolina. Now, the breakdown of exactly what their properties look like is not that important, but let's say they had a 12-unit building and a couple 12-unit buildings, a 10-unit, and then a group of 4plexes. But they all total up to about 50 units. And when you total up all the gross rent, so all the rent they collected every month is just under $50,000 per month, or $48,000. But remember, they don't keep all that. They have taxes, they have insurance, they definitely have property managers because they're not living locally, so they need to pay a manager. So when you deduct all of those operating expenses, they have about just under $29,000 left over. So just think about it in your head, under $30,000. But then they also have mortgage payments. And here's an important point. When they bought these multifamily properties, one of their most important considerations was playing the long-term game. So it was very important to them to get long-term financing on these multi-units so they could once again afford to hold. They didn't want to have 3-year loans or 5-year loans or something with a big balloon note. That's something I talk about a lot in the book, about Coach's 7 rules for using debt safely. My number 1 rule to avoid is to avoid big balloons. That's how a lot of big corporations, about a lot of real estate investors get in trouble, is having to pay the bank back one big lump sum in a very short period of time. But if you can extend those out, if you're going to do a balloon or an adjustable rate, extend it out to 7 years, 10 years, gives you, or longer, it gives you a much longer horizon to kind of get through the storms. And so Tiffany and Darius did that, but they had a mortgage payment, a total of $19,300. So if you're listening to this, I know all those numbers might not kind of gel, but when you subtracted their expenses and their mortgage payment from the gross rent they collected, they had about $9,500 per month. Almost $10,000 per month, or $114,000 per year in income from their properties after all is left over. Of course, there's some income taxes they have to think about. That's a whole nother episode and something to think about. But in general, they're going to be pretty good from the income tax standpoint because they'll have depreciation to shelter a lot of their income. And especially now, they're 15 years later, they're able to leave their job and they are very tax optimized, just living off their rental income. So this is a very different journey than Liz and Tom. But the themes I want you to think about are, number 1, they just got started with where they were. They had to do house hacking. They couldn't afford it. There was a very tight market. They only had a certain amount of money that didn't go as far in a high price market. They had to start with what was available and just make it work. They had to be scrappy. That's the word I like to use in those first years when you're first starting in real estate investing. And then they made a big move. They made this move of selling properties in one market where the equity is appreciated. That was the play they made. played. That was the game they played. And then they move it to a different market with a different game, which is more kind of balanced, cash flow centric. And so now they're able to live off of that equity that they moved into this different market by living off the cash flow from these multifamily properties. So you can see how, once again, this is kind of like a toolbox we had of financing. This is a toolbox of markets and types of properties. Each property has its pluses and minuses. Investing in a high cost of living market is difficult because the rent to price ratio is pretty tough. But typically, they're high priced for a reason. There's more people moving in. There's often a supply constraint. There's not a lot of new building going on. So owning existing properties in one of those markets tends to appreciate more. That's not a guarantee, is it? But over a long period of time, you tend to have some tailwinds behind you and you get more appreciation. When you go to these other markets, they tend to have more cash flow. Maybe they don't have as much of appreciation, although there are markets where they have both. But the point is, they're using the tools that they had to have the same amount of cash flow that Liz and Tom, doing it in a different way and doing it in about 10 years instead of 15 years by using some tools like 1031 exchanges. So let's wrap up this case study by just showing you again the final spreadsheet, or if you're listening to this, I'll explain what their net worth looks like in the very end. So remember, they started with those duplexes and with the houses in California. They sold those, so they don't own those anymore at the end. But they own these apartment buildings, these 50 units that total up to about $4.7 million, and they have debt of about $3.3 million. So their equity is just over $1.4 million. So that's the equity that they pulled from California. But they're getting about $114,000 in cash flow on that $1.4 million in equity. So they're doing really well for the amount of equity they have. They're able to live off that cash flow. And in both cases, these are kind of two different extremes. One using leverage, one being very conservative and paying the debt off. Both of these can work. Now, will your journey look exactly like Tiffany and Darius or just like Liz and Tom? No. As I said earlier, nobody's journey is exactly the same. Mine didn't look exactly like that. But the takeaway here, what I hope you take away from the details of this, is that the long-term real estate game is a game of tools, which you can also call techniques, and applying those tools strategically with a plan. So most people sort of get into the real estate game and they say, I'm going to learn how to do BRRRR. I'm going to learn how to use seller financing. And the strategy they have is just keep growing, get as big as you can. What I try to show you with this small and mighty real estate investor approach is that you need to understand the phases of the journey you're in. I kind of simplify this in the book by saying you're a starter, you're a wealth builder, and then you're an ender. An ender is when you take that off ramp to start making some different decisions. Maybe that's when you do the 1031 exchange if you're Tiffany and Darius. Maybe that's when you start paying debt off by doing a rental debt snowball or selling the excess properties. So you have different tools when you're an ender than you do when you're a starter. And that frame of mind, if you can remember that, if you can identify, and this is something, a good exercise for you to do after this episode, identify where are you? Are you more in the beginning of the journey? Are you in the middle of the wealth building journey where you just need to be patient and keep growing and buying more properties? Or are you reaching a point where maybe you want to take some chips off the table, to use a poker metaphor, and start moving into that ender phase where you can actually start tasting the fruits of the fruit tree, of this money tree that you built originally? Instead of just growing endlessly, you can actually execute a plan to live off of your income, to reduce the amount of time you spend on it, and actually take a deep breath financially. Maybe you want to travel. Maybe you want to start a garden in your backyard. Maybe you want to coach your kids, soccer team, or volunteer somewhere, or take care of your parents who need more time from you. There's an endless number of things that matter to all of us. And we just got to remember that real estate and money are fantastic tools to help you do that. But if you just focus on the tools and you just use those without a long-term strategy, then they'll kind of take over. In the book, I call this the Frankenstein monster. Your business can become an entity of its own. It can kind of get a momentum of its own, but you're the captain. You're the captain of this ship. And I hope this example in today's episode gives you a little more confidence as the captain of your real estate ship. And I would love to hear from you if you're watching this on YouTube. Let me know in the comments what your journey looks like. Where are you in the journey? Are you a starter? Are you a wealth builder? Are you an ender? Are you more similar to Liz and Tom in your approach? Are you more similar to Tiffany and Darius? Or maybe you have a different approach altogether. I would love to hear from you. It's always encouraging to hear your stories as well. And I hope you'll stick around for future episodes. I've got a lot more interviews coming with other people, both some new people you haven't heard of, other people that I've mentioned in the book. I'm kind of going back and interviewing people who I featured in the book. And then I'll also have more solo episodes like this. Let me know if you like these episodes where I'm going deep on different topics that I covered in the book and elsewhere to help you understand it better, help you apply it to your life. So thank you again for being here. See you next time. Hope you have a great week.